Have you ever wondered how a multi-billion-dollar company could be hiding in plain sight? What if I told you there's a company that acts like a secret toll booth for nearly every international flight landing in China, and yet the market might be completely undervaluing it? Well, today, we're diving deep into a fascinating company called China Aviation Oil. We've got our hands on a comprehensive research report, and we're going to break it all down for you: the good, the bad, and the potentially very profitable. We'll explore its secret weapon, its fortress-like finances, and why it might just be one of the most interesting opportunities in the energy sector right now. So grab your coffee, get comfortable, and let's get into it. But before we go any further, a quick and important note. This video is for educational purposes only and should not be considered financial advice. Please do your own research or consult a licensed professional before making any financial decisions. All right, so first things first, who is China Aviation Oil? On the surface, they're an oil trading company listed on the Singapore Stock Exchange. But that's like saying a shark is just a fish. It doesn't quite capture the full picture. CAO's main job is to supply jet fuel, and not just a little bit of it. They are the single largest physical buyer of jet fuel in the entire Asia-Pacific region. But here's where it gets really interesting. They are the exclusive importer of bonded jet fuel for China's biggest and busiest airports. Think Beijing, Shanghai, Guangzhou, the gateways to China. Now, what does bonded jet fuel mean? Imagine it's a special type of fuel for international flights that hasn't officially passed through Chinese customs yet, so it's tax-free. CAO is the only company allowed to bring this fuel in. This isn't just a business advantage. It's what analysts call a durable competitive moat. Think of it like this. Imagine you own the only road leading to a massive, bustling city, and you get to operate the only toll booth. Every car has to go through you. That's the kind of power CAO has in the Chinese aviation fuel market. And this power comes from its parent company, the China National Aviation Fuel Group, which is owned by the Chinese state. This government backing creates an enormous barrier to entry. Even global giants like BP and Shell can't just walk in and compete. They have to partner up with CAO's parent company just to get a piece of the action. But the company's history isn't all smooth sailing. And back in 2004, it was hit by a massive scandal involving unauthorized trading that led to over $500 million in losses. It almost destroyed the company. While it was rescued and has since cleaned up its act, that shadow of the past still lingers, and it's a key reason why some investors are still hesitant today. We'll touch on that a bit more later. Okay, so now we know what CAO does and why it's so unique. But is it a good business? Let's dive into the core findings of the research report, breaking it down into a few key areas. The first thing that jumps out from the report is the company's financial health. To put it simply, CAO is built like a fortress. Imagine a person who has $500,000 sitting in a savings account, owns their house outright, and has zero credit card debt. That's CAO. The company has a massive net cash position, over $515 million as of mid-2025. And its debt-to-equity ratio? 0. That's almost unheard of in the energy industry, which is usually loaded with debt. So what does this mean? It means they have incredible financial stability. If there's a market crash or another global crisis, CAO has a huge cash cushion to survive and even thrive. It gives them the flexibility to invest in new opportunities without having to borrow money. But there's a flip side to this. The report points out that having so much cash sitting around has led to a low return on capital employed. In simple terms, it's like having a ton of money in a low-interest savings account instead of investing it for higher returns. This underutilization of cash is a potential weakness that makes some investors question if management can effectively use that money to grow the business even faster. This brings us to our second and maybe most important insight. The stock appears to be on sale. The report highlights a major disconnect between the company's strong performance and its current stock price. Let's
or price-to-earnings ratio. This is like asking, if I buy this stock today, how many years of the company's profit will it take to earn my money back? A lower number is generally better. CAO's PE ratio is around 9.6. This is lower than its own historical average and lower than the industry average of 11.6. So you're paying less for each dollar of profit compared to similar companies. Second, we have the PB ratio, or price-to-book ratio. This compares the company's stock market value to the actual value of its assets on paper. A PB ratio of 1 means you're paying exactly what the assets are worth. CAO's PB ratio is just 0.75. Let me give you an analogy. Imagine you could buy a car, and the total value of its engine, wheels, seats, and frame is $20,000, but the seller is offering you the whole car for just $15,000. That's a PB ratio of 0.75. You're buying the company for less than the value of its physical assets. For a healthy, profitable company with tons of cash, that's a pretty compelling discount. So why the discount? This is likely where the company's history comes back to haunt it. That 2004 scandal created a cloud of reputational risk that has never fully disappeared. The market is essentially demanding a discount to compensate for that perceived risk, even though the company has been financially solid for years. We'll touch on that a bit more later. Okay, so now we have a financially sound company that looks undervalued, but where is the future growth going to come from? The report points to two massive opportunities, or tailwinds, that are pushing CAO forward. The first is the global recovery in air travel. This one is pretty straightforward. After the pandemic slump, people are flying again, a lot. Global air passenger numbers are climbing, especially in China. And what does more planes in the air mean? More demand for jet fuel. As the main supplier to China's biggest and busiest airports, CAO is in the perfect position to benefit directly from this trend. More flights mean more sales and more profits from its investments in airport fueling infrastructure. But the second, and perhaps more exciting long-term opportunity, is Sustainable Aviation Fuel, or SAF. This is essentially green jet fuel, made from things like used cooking oil or other renewable sources. As the world pushes to decarbonize, the aviation industry is under huge pressure to go green, and SAF is seen as the #1 solution. The market for SAF is projected to explode, with some analysts predicting a compound annual growth rate of over 80% by 2030. China itself has set targets to increase its use of SAF. CAO has already started trading SAF, positioning itself at the forefront of this green revolution. This isn't just about looking good. It's a strategic move to future-proof its business for a world that's moving away from traditional fossil fuels. However, the report also notes this isn't a guaranteed goldmine just yet. And the margins on SAF are still uncertain, and building the necessary infrastructure will require huge investments. So, while it's a massive opportunity, there are still risks involved. So, let's zoom out and put all the pieces together. What's the big picture here? The investment thesis presented in the report is built on a simple idea. There's a huge gap between CAO's real value and how the market is pricing it. On one hand, you have a company with an almost unbeatable competitive advantage in the world's fastest-growing aviation market. It has a fortress-like balance sheet with tons of cash and no debt, making it incredibly resilient, and it's perfectly positioned to ride the powerful waves of the air travel recovery and the green energy transition with SAF. On the other hand, the market seems to be fixated on the past. The ghost of the 2004 scandal, combined with the risks of being heavily focused on a single market, China, has created a risk discount. Investors are cautious. The report argues that this caution is overblown. It suggests that as CAO continues to deliver strong profits and proves it can effectively use its cash to grow, especially in the exciting SAF market, the market will eventually have to wake up and reevaluate the company. When that happens, the stock price could see a significant upward correction. It's a classic case of fundamentals versus sentiment. The numbers look great, but the story has some blemishes. The big question is whether the future potential can finally overshadow the past risks. So there you have it, a deep dive into China Aviation Oil. To recap, we're looking at a company with a state-backed monopoly on jet fuel imports into China's biggest airports, a rock-solid financial position with almost no debt, making it incredibly resilient. And it's perfectly positioned to ride the powerful waves of the air travel recovery and the green energy transition with SAF. So, what do you think? Is this a hidden gem or a value trap? Let me know your thoughts in the comments below. I'd love to hear your perspective. And if you found this breakdown useful and want to see more deep dives like this one, don't forget to hit that like button, subscribe to the channel, and share it with a friend who might find it interesting. Every click really helps the channel grow. Thanks for watching. I'll see you in the next video.